Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Thank you for joining my podcast today. Now, we're going to talk about why all of a sudden has these tech stocks, AI, gotten hit when we've heard the optimism over and over. Oh, this is different. This is different. This is great. We got funding. We got the same crap we heard in 2001. We're going to go and visit that. Okay, what that's all about. But here's something that's also we're going to visit is 401ks. Do you know that people are sitting back and not preparing themselves for another 2001 or 2008 or 2020? They're just sitting back. They don't remember the pain. It's like when you go to the dentist, you forget about the pain. That's what's happening here. I mean, think about it. In 2002, there was $1.2 trillion that was lost 2002 during the dot-com days in 401ks. So, and remember, we had a drop of 50%, 45 to 50%. So, and then, so that was 2007, or 2000 to 2002, 45% to 50% drop, lost 1.1 trillion in 401ks. Now, 2007 to 2008, we lost 2.4 trillion in 401ks. 25 to 30%, that was the typical loss for a participant. But it got up to 50% for older equity accounts. You know, the people buy and hold forever. They got really whacked heavy, about 50%. Now, let's think about this for a second. If you had $1 million, you got whacked. That million dropped to 430,000 in your 401k, a 57% drop. If you had $800,000 in retirement, it dropped to $528,000. That's a 34% drop. So here we are in 2026, and nobody's doing anything. People in 401ks aren't even worried about it. They're not even thinking about it. But they got to think about what caused those big losses in 2001, 2008, 2020 still exist, and they've done nothing about it. The industry's done nothing about it. What are you, nuts? No changes have been made. Ted Benner, the founder of 401k, says 401ks is a failed experiment. He doesn't like the 401k. So try to avoid riding that elevator all the way back down again. You rode that elevator down in 2001, 2008, 2020. Why do you want to ride it down again when it can be avoided? Now, remember, 401k, yes, it's a failed experiment. Why? Because they've been designed, they've been built to go to one direction. Up. That's it. Up. That's what it's designed for. When the market crashes, it's not designed to go down. They have no built-in, and this is purposely done, they have no built-in risk management. None. No risk management. You go take a shower, you got built-in risk management. I hope you do. You have a mat inside the shower. There's no built-in risk management, these people, the managers. And there's 3 layers of managers, by the way, that take your money. We talked about that yesterday. They're a bunch of crap when they say that you get an average return of 5 to 8%. That's BS. That's without all the open expenses, never mind the hidden expenses. You really got a 3% return to maybe 5% if you're lucky. But let's keep going. 401ks, remember, has been there's no, when they built them, they said, let's have no mechanism in here. We don't want any mechanism in here that is going to be, or risk management. Let's not do that. and because it'd be expensive. So let's not do that. And what they did is they built around 4 killers in this market, in the stock market. Buy and hold is one of the biggest killers. Oh, let's ride it out. That's another killer. This is the one that's a real killer. Cost average down. Market's going down in a downtrend, and they want you to buy more. Gee, if you liked it at 100, you'll love it at 30, Kramer says, with Enron. And think about this. There is no mechanism built in to rotate out of danger when your 401k is going down. It's been designed that way. You can't short. You can't hedge. So your 401k rode that elevator all the way down, 2001, 2008, 2020. Please don't do it again. Don't do it again. I mean, why? Now, remember, here we are again. Let's go talk about what's going on today. We'll go look at some stocks too. Remember back in December 2025, when they were reporting, boy, these data centers, these investments, boy, they're a record. What a record. They're making billions of dollars, and boy, the investments are tremendous. Everything's just wonderful. And I said, that's not true. That's not true. They're saying how there's so much demand. Okay, it's unstoppable. Data centers are just going crazy. Data centers are the new oil. Spending's accelerating. It's soaring. What could go wrong? And here's what I said back then. Go ahead and play the cut for me. There is, in Micron Technology, there's 4 cracks. Underneath this bubble, the A bubble, there's 7 cracks. Nobody pays attention to it. They mask it. And one day, they're all going to surface. And then that's when we're going to get hit. But in the meantime, nobody cares. So what I said back then was, no one's talking about the cracks. They're masking the cracks. And the more these cracks open, the more you're going to get a big correction. That's what we're seeing today. So they were telling us how everything was wonderful. AI demand, unstoppable. Spending, accelerating, not slowing. Buy. And I said they're all full of crap back then. Doesn't work that way. So, it's typical Wall Street, right? All optimism. And that's what they do. And they want to make sure you put out optimism, but behind the scenes they're selling short, they're hedging, they're saving themselves. So again, everybody talks bullish, but here we are back again. This is just a month ago. This would never happen. So behind the scenes, Wall Street, I'm sure the people that work for Fox Business and CNBC, they're buying gold. They're rotating to utilities. They're rotating to staples. By the way, today I'm going to show you some of the stocks that we're in. We've been doing fantastic. I'll show you those. But now the truth is catching up. That's what's going on right now. Why is this market, why are the tech stocks getting hit? Because the truth is finally showing up. The cracks are widening. That's what's going on. You got the 7 cracks. Not going to go through them all, but the 7, like China, they have a tech blockade, right? The power grids having a problem with limitations. They have data centers. They have shortages. They have, just chip supply. That's a real big problem. AI spending is the big problem. It's enormous. And the revenue's tiny. They've been BSing us, telling us what great returns. No. They are spending like crazy. But the returns are tiny. Now you take what's triggering the sell-off. Again, 95% of these companies, okay, who invested are not making a profit from AI investments. This went all the way back to 2025. I talked about it, but everybody poo-pooed it off. Don't worry about it. AI companies are losing billions. They're not making money like we're being told. They're losing billions. OpenAI lost $5 billion on $3.5 billion in revenue. Anthropic, I think is how you pronounce it, they lost $5.6 billion on revenues of $1.1 billion. How the hell do you do that? There's no profits. This is a repeat of 2001. Where's the beef? They're asking. Finally, everybody's, where's the beef? Where's the profits? There isn't any. Of course, CNBC, they lie like hell. And they're masking the massive debt that's going on. So this is another 2001.com. It smells it, it feels it, it really is. So the spending is enormous, but AI returns are terrible. Now let's go take a look at where you should be though. Let's go turn to my charts. So we've been doing terrific with stocks that's been showing relative strength. We've been in these stocks for a while. So let's go take a look. So right now, we are active. These are our active stocks we're with. I told everybody, stay with your banks, but the small banks, the regional banks, look how they're doing. Look at Truist. Look at my Pro 2, all solid green, look, going straight up. PNC, Key, these are all the banks I got everybody in. Industrials, we're in Caterpillar. Look at that, straight up. FedEx, straight up. Honeywell, straight up. Everybody is running now, dumping tech and going into these stocks and into the small banks, not the big banks. And they're going into industrials. Look at Pacecar, PCAR, the symbol. Beautiful. But you got to look at the volume. Always look at the volume. Volume's terrific. How about our defense contractors? We're in NOC. Look at this, straight up. Lockheed Martin, straight up. Now, I told my members today to start taking a lot of their profits in these defense stocks, these defense contractors, because they're going to start correcting too. Healthcare, we're in Johnson & Johnson, Merck, GILD, and discretionary, we're in the box stores, Walmart. Look how great Walmart's. It had a beautiful flag pattern. Target, Home Depot, Costco, even McDonald's is trying to break out. Starbucks trying to break, but look at Coca-Cola. Leisure, our favorite airline, ALK, Alaskan Air, finally getting some strength to it. Energy, remember energy. We've been in XLE, the ETF. Those are the big oil companies. And they're in one basket, XLE. But what you have to look at is XOP. Because XOP, if it's going up, that's the first thing you look at. XOP tells you the oil patch is healthy and strong. And that means prices are going to go up. XLE, remember, is the ETF for the biggest and best oil companies. Now, all these oil companies, people think that like BP and like Exxon and all that, they drill their own oil. No, they don't drill their own oil. What they do, these large oil companies, they're explorers. They find it. Then they bring in Schlumberger. They bring in Baker to do the drilling of that oil. And that's why we're always in XLE. Those are the big boys. And we always are in SLB, and we're always in Baker, because those are the two that go and do the drilling once they find it. So that's a nice setup to be in if you're going to be in oil stocks. Tech, nothing we're interested there, okay? Matter of fact, we made some money on, we did a swing trade short on Micron Technology this morning. So again, in the metals, GLD and GDX, all those, we talked about that yesterday. We still don't have evidence the trend trackers have not shown yet that this is definitely a big collapse that's going to stay. They're saying it's more profit taking that took this down, but we'll have to wait and see. So again, just be careful. Stay with the strongest stocks.